Next, we look at the uncertainty in financial decisions. In the financial side of the business, firm profitability may fluctuate over time. Also, there can be changes in the asset values or collateral values. There's in agriculture, you often see that land values can fluctuate quite a bit depending on its profitability. You have to consider the cost of credit, where particularly when you see changes in interest rates, that will definitely affect the interest rate paid on the production cost, machinery, and in some cases, some farms may have a variable interest rate on their land loans. Other uncertainties: the reliability and availability of data, the attitude of lenders towards strategies adopted by the firm, and the subsequent availability of credit. And this can vary over time. The farm has to be concerned with unforeseen financial needs, such as machinery breakdowns and additional operating expenses, such as an unforeseen increase in the fuel cost. You also have to consider the aging equipment and the obsolescence of equipment, the unforeseen opportunities for new investments and land purchases. Businesses need to be prepared to take advantages of investments and land purchases when appropriate and when available. The ability to meet the debt repayment and other adverse conditions, and also property rights. Some ways to reduce the risk in financial decisions are listed below. A business needs to develop a realistic financial plan that can be used by the business and can also be used to better market their credit. The business needs to improve their record-keeping system to increase their credit availability. A business can invest in less risky enterprises. That may mean the profitability may not be as high, but can reduce some of the risk. The firm needs to take measures to build and maintain liquidity. They can maintain a credit reserve to handle the unforeseen financial needs. They can also invest in liquid assets, assets which can be readily converted to cash should the need arise. The firm can form marketing, purchasing, and equipment ownership alliances, and a business can also consider using fixed interest rate loans to protect themselves against the fluctuation in interest rates. Some additional ways to reduce financial risk is listed below. One is for the business to set up sinking funds to replace machinery. They can also reduce the debt relative to their equity. They can initiate cost containment strategies, including holding down the fixed cost. They can cultivate and refine lender relationships through improved communications. They can provide lenders more detailed information, such as the break-even cost of production, their projected cash flows, their future expansion plans, and finally, a business can reduce some of the financial risk by getting a part-time job. Okay, next let's talk about decision making under risk. First of all, the business needs to identify the possible sources of risk. And we've just went through the production, marketing, and financial risks. Next, the business needs to identify the possible outcomes or events that may affect returns for the various business activities. They need to look at what would happen to the business if there were low prices or high prices, low yields or high yields. Then they need to identify various alternatives that they may be interested in pursuing. For example, the farm may want to consider growing more corn, or maybe less sorghum, or other types of alternatives that they can look at to consider and to observe the effect on risk. Then the business needs to quantify the consequences or results of each possible outcome listed above, or the event for several alternatives that the business is considering. For example, they might want to look at a situation where there's a 30% probability of high prices and a 70% chance of low price of a specific commodity, and then look at the consequences of this event. And then through this process they need to evaluate the trade-offs between risk and returns as they evaluate the alternatives that they are considering. Now let's talk about what constitute a good decision given uncertainty. A good decision is when you make resource allocations which are most likely in a probabilistic sense to produce favorable outcomes. Not guarantee it, but to create a situation where it's most likely to produce favorable outcomes. Favorable outcomes may be the result of either a bad or a good decision. Also, unfavorable outcomes may be the result of either a bad or a good decision. Good decisions only improve the chance of favorable outcomes. They don't, and they do not guarantee them. Again, talking about risk management. For individual enterprises, we perform what-if analysis. We identify a benchmark strategy, and then we identify alternatives. For example, forward contracting, maybe we introduce irrigation. Then we identify the possible outcomes and probabilities of each outcome occurring. And then we analyze the alternatives, particularly relative to the benchmark strategy, meaning what we typically do with that business or that farm. What if we institute some different alternatives? We need to analyze them, and we can then calculate the mean, the variance. We can even generate a cumulative distribution function to consider what the probability is that we might actually lose money if we implement any of these other alternatives or practices. And then from this information we select the best option. For the total business, we can use sensitivity analysis. Again, we identify the benchmark business strategy. Then, through sensitivity analysis, we evaluate worst-case scenarios for prices, yields, and cost, and look at that over time. We actually look at that through projected financial statements, so that we can look at the decisions that we make. We can look at it from a financial position, where we look at the projected balance sheet. This helps us look at the impact on our net worth. It also helps us look at our firm liquidity that we can obtain through the projected cash flow statement. We also can look at firm profitability that we can observe through the projected income statement, net present value, and the yield to the investment or the alternatives. Then we evaluate the trade-offs between the risk and returns for the different business alternatives that we're looking at. Again, we use this sensitivity analysis to choose strategies and alternatives to ensure a minimum level of income and also to ensure the survival